Good evening, everyone. Welcome to Friday's webinar. Firstly, I'd like to thank everybody for making your time to come to attend this webinar on a Friday night. I'm sure you have a lot of other things, but it's good to see you guys here. And I'm also quite happy to see a lot of new names here, new faces here, because this webinar is actually meant for people who are outside of our community. Whatever we are going to share here, most of those who are within our inner circle, they probably know what's going on already lah. So it's actually meant for new people who have like no idea what we are doing or what kind of strategy we use lah. Okay, so today's webinar is going to be a very long one. So I hope you guys are ready. You got your coffee, got your Milo, and the weather is quite nice also. So please don't fall asleep. I'll try my best to complete everything on time. So without any delay, right? Let's begin. So for those who are not aware, in fact, I have held similar webinar last year. So the recording for the last year one is actually available on our YouTube page lah. Okay, you can actually go and find this 80% ROI for 2023 and how to achieve similar return for 2024. So as per the screenshot just now, you can see that we actually achieved 85% ROI for 2024. In 2023, we achieved 80% ROI. So we performed a little bit better in 2024, but on average, our performance is somewhere around 60%, 65%, but 80% is a little bit above what we usually perform. Okay, so I will consider it as an outperformance. So first, let's go through the disclaimer a bit. We are only covering the stock market, mainly the US market. We will not be covering Hong Kong, Singapore, or Forex, or even the crypto lah. Okay, I am a no crypto person, so I will not be covering anything related to crypto. So our trading framework and strategy only applies to the US market, and this is for one very good reason, and it's because our framework is specifically tailored to how US economy operate. US is a debt-based economy. It is very consumer-centric. So the way how the businesses work, how the GDP contribution work in US is very different from, say, compared to the Japan economy or China economy. So what moves the economy in the US, the catalysts, the triggers are very different from what moves the China market or the Japan market. So if we apply the same strategy, if we look at similar data between US and China market, the end result might not be the same. So it is also very important to highlight that when it comes to trading, you cannot have a one-size-fit-all strategy where you use some very simple technical analysis and then you think that technical analysis can allow you to trade all sorts of market. In the real world, in reality, it does not work like that. The strategy, the framework have to be specific to a particular economy. Lastly, our framework is for trading, not for long-term investment. So our trading time frame is somewhere around 1 month to 3 months. So we usually hold our trade for 30 days, 40 days, 50 days. But if you are looking to invest in a stock for the next 10 years, 20 years, then our strategy will not be useful for that purpose. Okay. So just a little bit background about myself. Firstly, academic background. I have a bachelor degree in molecular biology and a bachelor degree in chemistry and biological chemistry or biochem. I have 14 years of experience in pharmaceutical industry as a molecular biologist and chemist. So you can see that my academic background has nothing to do with finance background. I actually took up trading as an interest, as a passion. And in fact, when I left my job to do full-time training, it was actually a very tough decision because my full-time job was very, very comfortable, great pay, great benefit. It is one of those that I will call retirement job lah. That you can just stay there and they will treat you very well. But I mean, I'm still young, so that this fire, there's this growth inside me. I want to explore the world of full-time trading more lah. So I started trading in 2013 with 30K. Of course, after starting trading, you wouldn't immediately see success. Like, okay, I actually lost quite a bit of money, paid some tuition fee. And then my first profitable year was in 2016 or maybe late 2015. I can't really remember the exact period. In 2019, my trading account grew to about 90K. And 2021, shortly after the full-blown COVID period, is where my life take a pivot. I left my full-time job at Roche. Roche is a very big Switzerland pharmaceutical company, not Ferrero Rocher. And I quit my full-time job to become a full-time trader. And at the same time, I landed an internship as an analyst in a London-based hedge fund. So I'm still currently under NDA, so I can't really reveal who they are yet, but okay. But as an analyst there, right, I actually get to work with a lot of actual hedge fund traders who used to work in Goldman Sachs, Bear Stearns, all the way back during the housing crisis days, really old bird 老将 who have tremendous amount of experience, and it was one of the best eye opener in terms of trading I could ever ask for. And somewhere around end of 2021, I founded Nimbus Capital Solution, a trading education company, which is through how most of you would know me, because Nimbus Capital Solution offers things like trading courses, a monthly subscription to have access to our trade idea, all this kind of stuff. Okay. And in 2023, my trading account grew to 200,000. And in 2024, I founded Protege 9 Holding, which is actually a private fund. So I'm actually managing a private fund. And in future, I do have big plans for Protege 9 Holding, and I will continue to share and explore more once I am able to get the time to expand this company in the future. So area of expertise in trading, it is the US market, quantitative and qualitative macroeconomic analysis, company fundamental analysis, options. So majority of the time I use option as my choice of instrument for trading, but for those who are not familiar with option, you don't have to worry, because for this particular webinar, I will not be going through anything related to options, okay? So don't worry if you have no idea what options are. And lastly, a long short portfolio management. So now, if you go and Google a bit, what is a hedge fund and what kind of strategy the hedge fund uses, you will come across this particular website. But what I want to highlight is a few things. So the first one is the purpose of a hedge fund is to generate positive returns uncorrelated to the broader market. So now you may think this is a word salad, like some mumbo jumbo, no meaning one. Actually, that's not the case. In fact, this particular phrase is very important, and the most important word in this phrase is uncorrelated, meaning to say that what hedge fund does is to get profit regardless of whatever the broader market is doing. It doesn't matter market is going up, market is going down, recession, no recession, market stagnant, whatever. The hedge fund strategy is to generate returns regardless of the market situation, regardless of economic situation. And this alone separate hedge funds from many other funds out there, be it investment funds or pension funds. Next, long short equity strategy. Long short attempt to profit from both upside and downside stock price movement by taking long position in underpriced equity and short selling stock that are deemed overpriced. And equity market neutral. Equity market neutral funds seek to offset long position in their portfolio with their short position to maintain portfolio beta near zero by pairing long with short. So I want you guys to remember this very carefully, because we will come back to this strategy later. The equity market neutral and this term portfolio beta near zero. Okay, so these are strategy that hedge fund uses, and you will realize what you are seeing here has nothing to do with all the terms that retailer like to use, like swing trader, scalper, don't know what lah, all the funny retail strategy lah. Okay, so hedge fund strategy are very simple in terms of their naming convention, and but in terms of how they operate, it is very complicated. And event-driven funds, so most of the time, when we are trading, we need to look for catalysts, and of course, catalysts are usually event-driven. So we will cover this later in the slides also. So today's agenda, firstly, I will go through the paradox of retail trading in the information era, common mistake made by retail trader, and the professional framework and trading strategy, the institutional trading strategy, our 2024 performance and key trades, overall outlook for 2025, potential trades for 2025, and of course, we will have a short Q&A session. So let's begin the paradox of retail trading in the information era. So now, after the COVID-19, the entire trading space kind of exploded. Everybody is now a trader. Any Tom, Dick, or Harry have a trading platform. So at one point, I was scrolling my TikTok and watching some video. I actually came across this video of a 16-year-old kid. He is saying that he want to um not go to poly or not further his study because he is making so much money trading forex, and in fact he is actually giving forex trading tips on his TikTok channel. He have a Discord community where he have a lot of followers, and he's actually giving forex trading signal, a 16-year-old kid. And this is a sign that the retail trading community is at its worst. Of course, I'm sure you all are familiar with the term. If a taxi uncle if a taxi uncle give you stock tips, it's time to sell. Or if your boot shiner is telling you to buy certain things, it's time to sell. But I think in this case, due to the information era, trading have become readily accessible to many people. As long as you have a SingPass, you can get your trading account on Moomoo or Tiger Broker. You can get it funded on the same day itself. I think within hours, you can actually trade ready, compared to say like 10 years ago when I was trying to open a Poem account. I have to go down to the actual office, sign a lot of things, and then it ends up that my signature on the CDP form is slightly different from the signature on my Poem account form, so they cannot link my CDP and Poem account together. And then there was like an additional 7-day wait and all sorts of issue lah, all sorts of issue. But it seems like nowadays everybody can trade, but. So anyway, the information ITH have brought significant advancement to financial market, enabling retail trader to access tools and platforms that were once exclusive to institutional investor. But one of the things that I want to highlight is also not just the tools and platform, but also communities. And I believe that within the retail trading space, right, communities are the worst in terms of preventing a trader from growing. So you may think that you are in a community, everybody share information here and there, everybody share this, everybody share that, some blogger sharing something, some guru trader sharing something. You think that you are growing, but actually, in fact, you are not. And community are the worst kind of barrier that prevent a trader from moving forward. And I will explain that further later. So, however, right, there are several ways where this ITH can be disadvantageous for retail trader. So, firstly, too much data. ITH has led to an overwhelming amount of financial data, news, and analysis. Retail trader may struggle to discern relevant information from noise, leading to poor decision making. So, when you are in this kind of communities, it tend to be an echo chamber. Everybody sharing whatever everybody thinks. Most of the time, people are just regurgitating whatever they see somewhere else. So in this echo chamber, right, everybody is just repeating whatever somebody else is saying, and you don't know where all these people are getting their information from. Also, sometimes somebody will say, oh, hot tip, this and that, then end up you lose money. So there's simply too much data, too much decision. And conflicting signals lead to access to multiple true opinions can result in analysis paralysis or following unreliable advice, information asymmetry. So you would think that since you have access to better data, for example, now everybody can use TradingView, can use Coinfin. I remember back in the day, we have to use Chart Nexus. We have to download the data at the end of the day, and then before we can start using Chart Nexus. But now everything is on cloud already, and you have access to all sorts of in-depth detailed data on TradingView, and is very, very powerful. But the thing is that whoever that is providing you all this data, they are actually the institution, meaning to say that the institution themselves have much more data than you, much better data than you, and they are selling you some of the data to you for a fee. So just because you have something better now doesn't mean that the institution are falling behind. In fact, they are accelerating even faster in terms of the tools that they have, and that create a very big gulf between the retail trader and the institutional traders. So algorithmic complexity, trader using automated trading system may not fully understand the underlying algorithm, exposing them to unexpected risks. For example, nowadays, robo traders are very, very popular, and then you also have trading gurus selling you their secret stock screener or secret trading system. You press one button, it does everything for you. Those kind, you don't really know what is going on underneath, and you might not be aware what kind of risk you are exposed to. So entertainment versus investment, many trading platforms gamify the experience to increase engagement, often encouraging high risk behavior that are more akin to gambling than investing. So Tiger and Momo are very notorious for this. They make trading become like a game like that. I mean, like as long as you are in control, it's fine. But sometimes a lot of people hand itchy there, itchy here. They tend to do bottom trading like, in order to hit certain achievement or what. So unrealistic expectations. Social media and platform often showcase stories of extraordinary gain, fostering unrealistic expectation and risky behavior. So I'm sure this one should be very familiar. A lot of crypto people gonna burn because they put so much money into crypto. Somebody put 1,000 and then get 1 million in return, and then you want to be that kind of person, and you are hoping that the next crypto will be your chance at becoming millionaire. All this kind of story, right? It lead to a lot of risky behavior. In fact, if you are a guy, I'm sure you all know about the hot Twa girl in US, and she basically scammed her entire community using a crypto lah. I mean, okay, I'm not really sure if she is actively involved, but there is a huge case going on now. Okay, so even right now, after so many cases of crypto scams and um certain crypto projects falling apart, even until right now, people are still falling for all this kind of absurd absurd promises lah. And addiction to trading app, easy access to trading app platform encourage impulsive trading, leading to poor risk management. And lastly, what I want to highlight in detail is echo chamber. So echo chambers has to do with communities lah. Okay, so I know a lot of retail trader like to join a lot of courses. Join one course not enough, must join every single course, and then they are part of every single community. They have access to like 10 different gurus. And when you are in this echo chambers, right, you are basically following whatever the community is saying or the community is sharing, and you have no idea where these people get their information also. And what happened is that a lot of trading community found little pockets here, a little pocket there, and since they are within their own little circle, right, they sort of like refuse to look outside also. Look, like they refuse to explore further also, so that pockets kind of like keep them like at where they are, and where they are is actually not how real trading is. And in fact, if a person truly want to learn how real institutional trade, how to become a actual profitable trader, right? They can't, because they are just stuck in that echo chamber. And that echo chamber also prevent actual trader from teaching them, the actual institutional trader from teaching them, because no institutional trader want to have anything to do with all these cesspool of retail community. It's like whenever I look at certain communities, what they are sharing, what they are saying, is like after I read a few posts, I'm like, okay, like I'm not gonna I'm not gonna like correct this person. Everything is wrong, but I'm not gonna correct this person. It's too much effort. I'll just let that person be lah. Sometimes I see a lot of funny stuff on City Facebook page and a lot of other Facebook page also. But after reading certain things, right, I feel very jaded. I feel very apathetic. Like I want to share, but when you share, right, a lot of response that you tend to get are not really those kind of response that are keen to learn also. So as somebody who have been through that institutional ritual, the process, right? I don't really want to share also because I mean you don't want, you do not want to be taught. So why should I share? So that's the true danger of echo chambers. It prevent you from actually learning the real thing. So right now, imagine you have the retail trader circle and then the institutional trader circle. There is no reality in this world where these two community overlap, because the retail traders are stuck in their own social circle, stuck in their own little group and their own echo chambers. And then the institutional trader who actually made it to that level, right? They don't want anything to do with the retail traders also. So that two world do not overlap, and because of that, right, there is no way to actually teach the retail trader the right way to trade. And most of the time the retail traders don't want to learn also, because what retail trader wants are trading signal, shortcuts, trade calls, whereas the kind of thing that is the institutional trader learns are very, very different. So, for example, retail traders are stuck in forums with a lot of misinformation spreading. So, this is a very sad case. I once attended a free webinar by a guru, a very famous guru, very popular in Singapore. I won't say the name. And he was sharing something regarding the yield curve about US Treasury and all this. So, you have to understand that when come to certain things in finance and economic, there is actually a black and white answer. There is the right answer and there is a wrong answer. So not everything in finance is your opinion, my opinion kind of thing. In fact, if you have sit through the proper academic channel, you take your economic bachelor degree, all this, right? You will learn certain things that are black and white true. So as this guru was giving his webinar, somebody on the floor asked him a question regarding the yield curve, and I'm not really sure what was the question about, but the reply that the guru gave was wrong. It was very obviously wrong. And for those who have been through any degree courses in finance, right, they will know it's just a plain wrong answer. But the thing is, the floor just take that answer as it is. They just accepted that that is the correct answer, and then everybody move on. And this is the kind of things that hurt retail trader, and that kind of echo chamber where the person who is teaching, the person who is spreading information, they have no idea, they have no credibility, they have no idea what they are saying is true or not. And then the person who are learning have also no way to tell whether what they are being taught is correct or not, and end up they fall deeper and deeper into their little circle that they cannot get out from. Charlatan guru giving bad advice, taking shortcut due to the lack of time. So this is the most common issue with retail trader, because, and it is very understandable also. I am very empathetic towards this, because I do have the luxury of, as being a full-time trader, I can commit all my time to trading. But for most retail trader, you have a full-time job. Sometimes maybe you have kids, you have other kinds of commitment, or sometimes when you get those one of the few days where you get a break from work, you just want to relax, you just want to go on a vacation. So you don't really have the time to engage yourself with trading activities and research and proper education. So what a lot of retail trader does is they look for shortcuts, they look for like instant profit kind of strategy, very, very simple shortcut strategy, trade calls, trade signal, and the best way to get all these kind of stuff is in the forums and in the little echo chambers that they are in. So they seek out all these forums and group, and they become a part of that group in order to get all these trade calls and whatever lah. Lack of process and regulation. So as a retail trader, there's no regulation, there's no process. So if I were to ask you from the step one, how you choose a stock to all the way how you exit the trade, right? Can you tell me the actual process, and do you follow that process for every single trade that you take? Most of the time, the answer is no. And in fact, if I was to ask you how long is the process from start to end, right? Sometimes like you wouldn't even take like 5 minutes, because most retail trader, how they trade is they will see a trade call on Facebook or in their Telegram, and then they immediately take out the phone and enter the order already. They don't really do anything else. So there is a lack of process, lack of oversight, lack of somebody who is guiding you, regulating you, and that lead to a lot of trading mistake that you yourself wouldn't even recognize, and you will keep falling, you'll keep making the same mistake over and over because there is no process involved. And of course, seeding trade calls and signal instead of proper academic education. So a lot of retail traders like to go for courses, but when they go for courses, right, they don't really want to learn the proper academic education on how to trade properly, because I believe no trading course out there also provides that. Most trading courses are just 1 day, 2 day kind of thing, or sometimes it can be 1 month boot camp kind of thing, but none of them really teach retail trader sufficient enough information to be a proper trader. So most of the time, when retail traders go for this kind of course, what they want is they just want the post-course community, post-course trade call. And this is one of the things that I truly feel sad, because every time, whenever a course ends, the very first question that I will get, or whenever if people ask for my course, one of the questions that I get is, after course got trade call or not? After course got hold hand or not? So that is the thing that they are looking at. And whenever I get those kind of questions, it kind of makes me not want to take in this person already, because this person is coming here, they want to just rush through the process and get the trade calls at the end. So now, on to the institutional retail trader. Whenever an institutional trader have a trade idea, that trade idea has to be documented. There have to be proper documentation. You have to sign up. You have to show proper research, and it has to be jotted down in a Microsoft Word or whatever software that they are using. And not only that, right? That particular trade idea have to be peer reviewed. So if you are an analyst, your trade idea will probably get reviewed by a senior analyst before it goes up to the portfolio manager, or before it goes to the senior portfolio manager. And after it finally get approved, then the trade will actually be taken, which is a very different process from what retail traders are doing. And this process alone, right, it certifies that the trade idea is of quality. There are people looking at it, there are people judging the trade idea, there are people determining whether this is a good trade or not. Whereas for the retail trader, there's no such process involved, there's no regulation involved. And in fact, if I were to ask you to show me the last 5 trades that you have taken and give me the documentation, the research that you have on the last 5 trades, most of you will not be able to do it. In fact, I would say 100% of you would not be able to do it, because you don't have the proper process. But in the institutional trading, actual hedge fund, analysts and portfolio manager need to be accountable, because if a trade idea goes wrong or if something happens, documentations are available. They are available in order to backtrack to see what went wrong, and from there we actually learn something. We actually know what not to do, where things went wrong, who is slacking, who anyhow approved this trade, that kind of stuff lah. But in retail world, right, no such process. So the process flow is government by regulatory body. So the fact that we need to go through peer review, we need to document our trade, get it signed, get it approved. This entire process is governed by a regulatory body. At the end of the year, when the hedge fund get audited, we need to show that every single one of our trade has a research document. If there is no research document, right, it will be considered like, oh, maybe you get a insider information. That's why you trade it, and but and and God bless you if you take a trade with no research document and that trade end up as a big profit, right? God bless you. You are probably gonna jail for some insider trading. So a research document is absolutely necessary, and there are government bodies that regulate this, so you cannot escape that. But there are reasons why these processes are in place, because that these processes are what make institutional trader accountable and so profitable. That's why they are earning 500,000 a year, 1 million a year, based on the kind of funds that they are managing. And most institutional analyst traders spend over 60 hours a week on research. So in order to come up with one trade idea, they will spend over 60 hours on, I mean, sorry, not one trade idea. Probably if they want to come up with 2 or 3 trade ideas, they will actually spend the entire week over 60 hours to do a lot of research. And this is something that retail traders don't do. And as I mentioned earlier, most retail trader, if they want to enter a trade, they take less than 5 minutes, because they see that trade on Facebook or Telegram, they simply take out their phone, enter the trade, and that's it. But institutional trader, they spend over 60 hours a week. And in fact, I personally spend about 5 hours in order to come up with one trade. And even right now, I document my trade, like how I used to when I was an intern as an institutional trader. So that documentation is very important, because if you can't write down what your thought process is, then you can't trade. You do not know enough to trade. So my analysts also spend about 4 or 5 hours to come out with one trade idea, and sometimes we can spend over 2 3 days with 4 5 hours each day just to research over certain things before the trade goes live. So certain stocks that you see me posting, right? Those are not suka. See the technical, like the moving average crossover, then trade ready. It is not like that at all. So imagine you are a retail trader, you spend less than 1 hour a week to look at your trading, obviously you're not gonna make it. So because of all this, right, institutional traders have high barrier for entry, and that high barrier actually weed out anybody who just want quick money. Okay, we are just here for quick cash, one quick trade call. Those can't be institutional traders simply because of the high barrier. But retail trader, there's no barrier at all. Any Tom, Dick, or Harry can come in, and that's why so many retail trader fails. So, and of course, accountability, as I said, your name, your signature is on every trade research that you do. So you have to be accountable. But for most retail trader, if they lose a trade, maybe blame the market, blame the guru, blame the Facebook group that they are following. So it's a very different world. And once again, to emphasize, this two group of people is very unlikely that they will ever meet or they will ever interact, be it on Facebook or real life or wherever. So most retail traders are unwilling to undergo the rigorous process and commitment required of institutional trader. Instead, many seek shortcuts. And as a result, right, retail trading community is inundated with self-proclaimed guru who promise effortless system with big profit, catering to what retail trader desire. So imagine there are two-person. Person A tells you that you can get 50% return every year. All you need to do is buy his secret system. And every day you only need to spend 5 minutes on his secret system, press one button, the system will give you a trade, and then you just copy that trade. You keep doing that for the entire year, you will get 50% ROI. You only need to spend 5 minutes a day. And then you have person B who is telling you that in order to be a profitable trader, a truly profitable trader, you need to sit down about every week. You need to set aside about 20 hours per week. You need to do a lot of Excel spreadsheet, put in a lot of data, go and dig Google for a lot of research documents. After that, you do ready before you take a trade, you must have a research document that you write, and then you have to show me, and then I will approve the trade. And then you have to do that for the next 2, 3 years, and then maybe you may get 50% return for the year. So between these 2%, what which one will retail trader choose? Of course, the retail trader is going to choose the first guy because that is what they want and that is what they desire. Whether or not is it true or whether or not it is like reasonable, they don't care because that is what they want. So when a lot of people ask me about fake gurus, right, I don't really blame the fake gurus because the fake gurus are there because they are offering what the retail trader wants to hear. So in fact, I will say that the presence of fake guru is as much of a fault on the retail trader also. If the retail traders are not greedy, they don't want shortcut, they want the proper process, right? Then fake guru will have no customer, they wouldn't exist at all. So because of this, institutional traders and retail trader, we operate in completely different world and will never truly intersect because no institutional trader want anything to do with retail trader. Also, likewise, retail trader don't want anything to do with institutional trader also because they do not have that level of commitment to learn the actual thing. They will rather learn all the shortcut method from fake gurus. So unless retail traders change their mindset, they will remain trapped in their echo chambers of forums and trading communities. So it is my dream or it is my hope that one day the world of institutional traders and retail traders can intersect. And I also truly wish that one day certain retired institutional trader will come out and be a little apathetic, set up like an education shop and then teach all the retail trader. And of course, on the retail trader ends, I also hope that the retail traders can be smart enough to understand that mastering trading is not a simple task. Mastering trading is not based on secret formulas, secret software based on forums, chasing trade signal is not based on that, but it's actually based on actual work. And I hope that retail trader can actually understand that and go out there and seek the proper education. And I hope these two people will one day meet a community, an actual community is formed, and from there everybody can win. And I hope that I can be that little overlap that is happening. So in terms of our Nimbus Capital solution, our mission is I want to bridge the gap between the retail and the institutional traders in terms of knowledge, process, and self-regulation. But of course, I'm not so howlian to say that I am going to achieve it or I have achieved that. In fact, I will say that very sadly, even until right now, I have failed in this mission. Every 10 traders that I take in, only one will follow through. The other 9 will go back to find other guru, go and still on forum asking for trade calls, still looking out for secret holy grail software, or still asking for trade setup here and there. Only perhaps 1 out of 10 will actually give me a proper research document. And sometimes I'm not. Sometimes I also feel that maybe my way of teaching is a little bit dry. They are not engaged. Or is it truly that retail traders are just cannot be saved from themselves? The way that they are their mind is being how do I call it? Their mind is being taught to handle trading. But we shall see how it goes over the next 10 years. It is a monumental task. So now, common mistake made by retail traders. Firstly, the binary mindset. A lot of retail traders have binary mindset, bull or bear, up or down, recession or no recession, buy or sell, long or short. Everything is a binary mindset, okay? A or B. But for an institutional trader, right, we don't adopt that mindset, and you will learn more later. Positive beta portfolio. So now you are starting to learn new terms, positive beta. We learn beta portfolio beta earlier in one of the slides. So something that you need to take note. do not understand what proper diversification is. So now a lot of traders think they are doing diversification, but actually they are not. So because they don't really know what diversification is. So they may think that they are diversifying, but they are not. Overly focused on technical analysis. So this is one thing that I want to cover in depth. That's the reason why it's bolded. So technical analysis is the least of the thing that we will do in terms of research when it comes to picking trade. Institutional trader pay little to no attention to technical analysis. And in fact, like during our early morning meeting, during our brainstorming session, war room session, when we discuss certain trade ideas, nobody talk about technical analysis. Nobody cares about technical analysis. And in fact, within the entire framework, technical analysis is probably like 10%. 10% of the framework. The other 90% is everything else. Okay. So this may be something new to you because a lot of traders believe that TA is for trading, which is garbage. I'm not sure where people learn that from. TA is definitely not just for trading. I mean, trading don't just use TA, but there's a lot of things that we have to use. Ignoring the fundamental and macroeconomic impact of trading. So in fact, our framework actually majority is covered by fundamentals and macroeconomic. Okay, every stock is driven by a fundamental driver. It is your job to find the fundamental driver. Overly focused on picking the right stock than the overall portfolio. So a lot of trader die look at one particular stock. This stock can buy or not. This trade can cut or not. Can take profit or not. But the issue is that from an institutional perspective, we look at the portfolio as a whole. For example, we treat the portfolio like a soccer team. Like if you have 10 trades on your portfolio, all 10 trades cannot be like attacker or defender. They have to be a mixture. Some like a football team, right? You need a goalkeeper, you need some attacker at the front, you need some defender at the back, all those kind of stuff. Okay. So we look in terms of performance, we look at the overall portfolio. We don't really focus on one particular stock, which comes to our next point. Retail trader don't really pay attention on regards to the overall portfolio. They don't really care what their overall portfolio is like. And they only focus on well-known companies like Nvidia, Palantir, Tesla. They don't see anything beyond whatever that is within their comfort zone. Okay. And in fact, in the US market, there are so much hidden gem that is waiting to be picked, but nobody knows about them. People only knows about them after the stock already run, I don't know how many percent already. Like I remember the very first time we bought Palantir was at $6. Nobody want to buy Palantir at $6, and now Palantir is that like 70, $80. People asking me can buy or not. So that's the kind of attitude that we are dealing with when it comes to retail trading. So does not understand beta hedging. Beta hedging is very important. Keep that in mind. Does not understand what is volatility. So volatility, once again, is the kind of word that retail traders like to use a lot, but they have no idea what it means. If I ask you, how do you calculate volatility? What is the industry standard for calculating volatility? Nobody will be able to answer that because they have no idea what volatility is. They just know the English meaning. They don't know the trading meaning of volatility. So the limitation with current trading strategy, most trading strategy, investment fund, unit trust are what we will call beta fund that achieve beta return. So this beta is actually a financial term that has a financial definition. Beta return refers to the portion of investment return that is attributable to performance of the broader market or benchmark index. It is directly related to the beta coefficient, which measure asset sensitivity to the movement in the market. So what this basically means is that beta returns are returns that is attributable from the broad market, meaning to say you have a portfolio with a positive beta. If S&P goes up, if the overall market goes up, your portfolio goes up. If your overall market goes down, your portfolio goes down. If there's a recession, market crash, then your portfolio also crash. That is beta return. So now I want you to focus back to the hedge fund strategy slide that we saw earlier. And one of the description is that hedge funds, we get returns regardless of broader market. So what hedge funds are trying to achieve is not beta return. We don't want beta return. We don't want return that have to do with the broader market. We don't care where the broader market is. We want to make money regardless of whatever going on in the broader market. Beta funds allow the movement of benchmark. Beta funds follows the movement of the benchmark, mostly S&P 500 or various MSCI index, and attempt to outperform it. So for example, if your S&P moves 20%, your portfolio moves 25%, you're very happy, you outperform S&P. But let's say if S&P crash 10%, your portfolio crash 5%, you're also very happy because your portfolio didn't crash as much as S&P 500. So you technically outperform the movement. But my question as a trader is that why are you losing money? Just because S&P crash doesn't mean you must also crash. You, even if S&P is negative 10%, negative 20%, your portfolio should be positive regardless of whatever going on in S&P 500, because we are traders. We are traders. We are not investors. If you have a passive investment fund that is following the broad market, that's fine. But if you are a trader, you are spending so much time exiting trade, entering trade. Why is your portfolio being negative? And that's the reason why we do not want beta returns. Okay. Retail trader strategies are similar, as they will attempt to catch the market trend via various indicators and screeners. Retailers try to outperform the market through leverage instruments such as CFDs without really realizing that they are increasing their risk as well. So from a volatility perspective, they are not really gaining any advantage. They are simply increasing their performance by increasing their risk. So at the end of the day, if they lose, they are going to lose more, and end up that is often the case. So from the perspective of risk-adjusted return or Sharpe ratio, beta strategy severely underperforms, sorry for the typo, compared to alpha return that are generated by institutional hedge funds. So alpha return refers to absolute return, meaning these are returns that is not connected, not correlated to the broader market. So at the end of the day, beta strategies are which retail traders use are actually at the mercy of market direction and volatility. So guys, I want you guys to take a look at this for a while, and then we will go through what we are looking at here. Okay, so now let's take a look at this highly diversified portfolio. So we have this particular trader here. His portfolio have a total of 8 positions. You should be familiar with all these 8 companies here: Apple, Amazon, Tesla, Microsoft, Nvidia, Occidental Petroleum, Visa, and United Health. And all the allocation are similar. Okay, so he allocated all the position equally, and all the position are long position. And if you look at all the sectors, it is actually very well diversified. Apple, consumer electronic; Amazon is internet retail; Tesla is an auto manufacturer; Microsoft is tech software; Nvidia is tech hardware or semiconductor; Occidental Petroleum is energy, oil and gas; Visa is financial, consumer credit service; and United Health is healthcare. So we have some exposure in the defensive sector as well. And on the furthest right-hand column, you will see this, what we will call the beta coefficient. Okay, we have a beta coefficient. So this number tells you how much the stock correlates with the market. So in this case, the market is S&P 500. So now if I add up all the beta numbers and I divide by 8, because there are a total of 8 positions, we will have a average portfolio beta of 1.34. So now what does 1.34 mean? If you understand correlation, 1.34 means that this particular portfolio is highly correlated with the S&P 500, the benchmark. So to put it simply, if S&P goes up 1%, this portfolio will goes up 1.34%. If S&P goes down 1%, this portfolio will go down 1%. So you can treat the beta number in that sense lah. But of course, I mean not that accurate lah on a daily average lah. Okay. So what it means to say is that regardless of how diversified this portfolio is, right, it is still at the mercy of the broader market movement. If the market is going to crash, this portfolio is going to crash, regardless of how diversified it is. So the trader may feel a false sense of security because he thinks that his portfolio is diversified across different sectors. If the market were to drop, his portfolio should be able to weather the storm. Unfortunately, his portfolio is highly correlated with the market, and this is what we mean by a beta portfolio. If your portfolio is equal to 1 or higher than 1, it is a beta positive portfolio. So an average of 1.34 beta suggests that every 1% downside of the market, his portfolio will decline by 1.34. So this portfolio is a beta positive portfolio, and it is actually still at the mercy of broader market movement. So if a recession were to happen, S&P drop 20%, highly likely this portfolio is going to drop 23%. So if the market crashed sufficiently enough, like in January 2022, where the market crashed about 10 to 12% within like 1 week, it is most probable that all the position in this portfolio will be stopped out and the trader will suffer a huge loss. So this diversification across different sectors did not help. So this is also a very good example of doing diversification wrongly, because perhaps the trader don't really understand what diversification is. So as trader, right, what we want to achieve is a portfolio that is close to beta neutral through what we will call beta hedging. So a beta neutral portfolio have an average beta of 0, very close to 0, probably like 0.3, 0.5, somewhere around there. And this is where we will achieve what we will call alpha return. Because if you have a beta neutral portfolio, then your portfolio is no longer correlated with the market. You don't really care where the S&P 500 is going, whether it goes up, whether it goes down, or whether it's stagnant. We don't care. We will get profit nonetheless. Of course, the $1 million question is, how do we achieve this? The next topic is, of course, the institutional trading framework on how to achieve a beta neutral portfolio. So once again, right, I'm flashing back the slide from earlier. So in order to achieve a beta neutral portfolio, we have to use something called the long short equity strategy, or the equity market neutral strategy. And you can even have a hint of what and how we achieve beta neutral portfolio. You can look here, this one. Equity market neutral funds seek to offset long position in their portfolio with their short position to maintain a portfolio beta near 0 by pairing long and short. And that is what a long short strategy is. We will pair a long position with a short position, like got partner like that, okay? Like your dance partner, every long position will have a dance partner, which is a short position. So all institutional funds, hedge funds, employ the same strategy, a long short portfolio. So we structure our portfolio with both long and short position to get a beta neutral state while still maintaining a sufficient portfolio volatility to get absolute return. So do not misunderstand this sentence. Your portfolio needs long and short, not long or short, okay? It doesn't mean, oh, today I everything long, tomorrow I everything short. It's not like that, okay? It's you have both long and short at the same time, which is something a lot of retail trader cannot comprehend. Like you look bullish, then why got short, or you bearish, then why got long? Like it's something very new, lah. Okay, so make sure you don't get the description, understand the description wrongly. So beta is a measurement of your stock or your portfolio performance relative to the market. So as I mentioned earlier, most trading strategies and investment funds are beta positive. If the market does well, the portfolio does well. If the market crash, then the portfolio crash. So by structuring our portfolio to a beta neutral state, we become independent from the market and we are able to generate profits regardless of the market performance, hence absolute return. So this is what we mean by absolute return or alpha return. So this is actually our edge. Our edge is that we don't care where the market is. We don't need the market to make profit. We can make profit regardless of what the market is doing. And hedge funds are called hedge funds because they use long short strategy. The fund is always beta hedge against the market movement. So the goal of a long short strategy is to remain market neutral or beta neutral by constructing a portfolio with equal number of long and short. So example, we have 4 long position and 4 short position. So the long positions are companies with strong fundamentals. Short positions are companies with weak fundamentals. So stocks are chosen based on fundamental factors such as, but not limited to, earnings growth, sales growth, expanding margin, and etc. So for all position, an immediate catalyst must be present because as trader, right, we are not investor. We want the stock to move within a very short time frame. So within, like, say, the next 1 to 2 months, there must be a catalyst present to move the stock. And the most common catalyst that we look for is company earning release. Whenever a company release their earnings, the stock will move, or even 1 to 2 weeks before the earning or 1 to 2 weeks after the earning, the stock will still be moving. And company earnings occurs every 3 months. Quarterly, there is quarterly earning season, which will come every 3 months. So this gives us a very nice trading time frame of 1 to 3 months of holding this particular trade. So the idea is to cut the losers. So you have 1 long and 1 short. Whichever there is losing, you cut it off. Whichever there is winning, you hold on to the winner. So of course, on paper, this sounds like very easy. And in fact, this is a crash course to a long short strategy, okay? But please don't, like, after this webinar, go and suka pick 1 long, pick 1 short, and then go and do 1 long short portfolio. So as those advertisement will say, right? Please do not try this at home, okay? You do need to go through proper education and proper strategy to execute this correctly. But treat this as exposure to what the institutional traders are doing. So now imagine this neutral portfolio. An example of a neutral portfolio, you have 4 short position and 4 long position. So there are 2 things that can happen. And if, let's say, the market rallies, what we will do is we will cut the short to limit the loss. Of course, you will have your stop loss, you will have your risk reward ratio all planned out, you have your profit level all planned out already, okay? So you are just following your trading plan. Whichever that is losing, in this case, since the market is rallying, it is highly likely that your shorts are going to lose. So you cut the shorts, and highly likely that your longs are going to profit. So you let the profit run. So what's going to happen is maybe all the shorts you're going to lose $100, $100, $100. But because now you are letting your longs run, right, you will get $200, $200, $200. So this is a 1:2 risk reward ratio, okay? And 1:2 risk reward ratio is something that is easily attainable in market. Sometimes you can even get 1:3, 1:4, but we are using conservative numbers, okay, which is 1:2. So in this case, you are going to lose $400, but you're gonna gain $800. So you have a net $400, okay? Or for every pair that you have, for every long short pair that you have a profit $100. What if the market crash? If the market crash, then you are going to cut the longs because your longs are going to lose money, but you will let the short run in order to get the profit. So you have a opposite situation. You lose $100 on all your longs, but since your shorts are making money, you're going to make $200, $200, $200, and $200. So once again, this is a 1:2 risk reward ratio. So in this case, wherever the market goes, right, be it the market rally or be it the market crash, you are bound to make $100 for every long short pair that you have. You don't really need to worry about what the market is doing. So for every 8 trades, for every 4 pairs of long short you execute, you will be able to get $400. And if you are able to execute like 100 pairs for the entire year, then you're going to get $4,000 for the entire year. And of course, I mean, you have to do your own money management lah. What is your total portfolio capital? What is your risk for every trade that you are taking? But that is another topic for another day lah, okay? But this is a very, very simple, very crude example of how a neutral portfolio, a long short portfolio works. How regardless of where the market is heading, you are able to get profit. So whenever we enter or exit trade, we must look at the portfolio as a whole. We must look at the portfolio as if it is your whole soccer team. You have to make sure that every long have a partner, every short have a partner. So new trades added to the portfolio will actually affect the overall portfolio beta value, and it will also affect the overall portfolio volatility. And so does exiting or removing trade from your portfolio. If you exit a trade, right, it will decrease your portfolio beta or it will increase your portfolio beta depending on whether you exit your short or long. So the next trade we choose to exit or enter, it actually depends on the state of your current portfolio. A trade does not exist in a vacuum. It exists as an integral part of the entire portfolio. As such, right, when we are looking at floating profit and loss, we do so on a portfolio level. We don't really care if individual trade is losing money or if individual trade is gaining money. Because we are doing long short, some trades are bound to lose money. We don't care. But the only thing we care is that our overall portfolio is going up. And it should be going up regardless of whatever happening to the market. So this is actually the first of many differences between a professional trader and a clueless retailer. Because a lot of retailers only focus on one particular trade, whether this stock can go up or not, that stock will go down or not, or should I hold this stock, should I cut loss? But that sort of decision you cannot make in a vacuum. You have to take a look at your entire portfolio and see whether you should be cutting this or is there another trade that is running that you can hold on to, or should you be cutting that loss? So the decision get compounded based on what other position you have in your portfolio. So because of this, right, the proper institutional term is actually portfolio managers or PM. So at the hedge fund level, there's no position called traders. There's no trader position. There are analysts, there are portfolio managers, but there are no traders. So terms like scalper, swing trader, day trader, wave trader, chart pattern trader, candlestick trader, like that, there is actually a candlestick trader strategy. I don't know what the fuck is that, but these are actually terms invented for the retail world for marketing purpose. And on an institutional level, right, there's no such thing. So if one day, if you are fortunate enough or if you are skilled enough to be interviewed into a hedge fund and they ask you what kind of trader you are, please don't tell them you're a scalper or you're a swing trader. most likely they will kick you out on the spot. Okay. Please tell them that you know what a long short portfolio is. So let's continue a bit. Depending on the state of the market cycle, right, or various macroeconomic drivers, we can actually shift our portfolio to slightly beta positive, slightly beta negative, high volatility, low volatility. So you think of it as a volume setting, okay? So the way to manage a portfolio is not an on or off, but it is like a volume you can adjust whether you want a slightly positive beta or slightly negative beta. And you can adjust it through your long short portfolio management. It does not necessarily have to be for long, for short. If you are feeling slightly bullish, you can go 5 long, 3 short. Or if you are feeling slightly bearish, you can go 5 short, 3 long. There is a little room for you to maneuver a bit in order to push your portfolio performance. But at the end of the day, we do have hard guidelines on what is acceptable as a neutral beta. For example, you can have 5 long and 3 short and still achieve neutral beta. But if you go 6 long and 3 short, you may be no longer neutral already. And that is not acceptable within the scope of a long short strategy. But that is a bit too advanced to cover in this webinar. So I'll just go through briefly. However, right, there must be a combination of long and short, okay, in order to maintain that beta neutrality. So the degree of biasness, right, whether you are bear or bull of our portfolio, it will be dependent on macroeconomic drivers. So we do not trade index, and because we do not trade index, right, we can express our degree of bearishness or bullishness via our portfolio beta level. So that is your volume setting, okay? You can set your volume, think of it as your beta level. Whereas, right, a lot of retail trader, they are stuck with either 100% bull or 100% bear. If you long S&P, you are bull. If you short S&P, you are bear. There's nothing in between. And because of that, right, they tend to lose money in the long run because most of the time they are flipping a coin. But for a proper hedge fund portfolio manager, right, we are not subjected to that. We can actually control our bullishness and bearishness, the degree of bullishness and bearishness. So we have an example of a credit cycle or the economic cycle. Based on what stage of the cycle we are in, we can adjust our portfolio to a neutral portfolio, a beta, slightly beta positive portfolio, or a slightly beta negative portfolio. So the trading framework is very simple. We begin from left and then we make our way to the right. We will use top-down macroeconomic analysis to determine whether do we require a neutral portfolio or a positive beta portfolio. And then we use fundamental analysis to spot trade, to look out for certain company, to choose the company that we want to trade. And then we will use technical analysis for timing. This is very important because we do not use technical analysis to choose the trade. By the time we look at TA, we already know what we want to trade. The TA is just there for entry timing only, which is very different from retail trading because a lot of retail trader buy a stock because it is at the support level, or they short a stock because it broke the support. They choose the stock because of TA. But for us, we choose the stock using fundamentals. And lastly, we have trade implementation. We have trade structuring. Trade structuring is where we set our profit level, where we set our stop loss level. So we actually have to look at the volatility of the stock. Not all stocks are the same. Some can be more volatile than the other. So based on the stock volatility, we need to widen the stop loss or widen the TP level based on how much the stock can move. And of course, risk management, money management, and finally, the entire management of the portfolio, maintaining that portfolio neutrality. Okay, so now, one of the common question I get asked is, Zor, trading short term, trading short term, then what's the point of fundamental analysis? Fundamental analysis is for investor because a lot of FA only plays out in the long run, which is not really true. In fact, I want to give you guys a very quick exercise. Sorry, this one typo. It should be higher. Okay, so now I have two stocks here, stocks A and stock B. So both are AI related stock, okay? Both are related to AI. And you can see from the chart itself, both stock A and stock B, technical wise, they are somewhat similar. Okay, somewhat. I'm not saying they are exactly the same. I mean, looking at the chart, of course, they are not exactly the same, but they are somewhat similar. You can see both of them are somewhat trending down, and then both sort of created like a double bottom like that, and the momentum is heading back up. You can see from the MACD, the RSI, the momentum is heading back up. And for both MACD, right, it's above the zero. So you can see the stock price actually moving above the moving average line. And the moving average are also like starting to cross over each other. So it seems like a recovery from the bottom. Okay, seems like. Okay, so based on this, what you are seeing here between stock A and stock B, which stock will go higher, which stock will go lower in the next 4 weeks. So I'll give you guys about 5 minutes until 10:30. You can write your answer in the chat. Okay, maybe 5 minutes too much, but maybe about 2 minutes. Write your answer in the chat and then we will proceed forward. I think those who are in my community will probably know what stock B is. Stock A is random, but stock B is something everybody, I mean, those in my circle should know. Come, don't be shy, don't be shy. We don't have a lot of time left. I think we are only halfway. B what? Higher or lower? B higher. Sorry, okay, I got a lot. B higher. Stock A. Stock A what? Stock A higher or lower? B higher. A lot of B higher. You want anyhow, is it? Echo chamber already. Stock A higher. A higher, B lower. B. Don't echo chamber, okay? don't prove me right. Come, more answer. Don't be shy. B higher, A look like will trade in range. Yeah, not wrong. Actually, not wrong. Come, we got 50 people here. More answer. Okay. Let's move forward because we don't have a lot of time. So majority say B higher. A lot of you say A lower. But I mean, I will assume that the reason why you are saying B higher, A lower, or A higher, B lower, whatever, is purely based on what you are seeing in terms of the technical analysis lah. Okay, so I can't really find a very good example. Also, I did try to find the best that I can. because I do want two AI stock, and I also want to I also want the example to reflect the same period. Okay. So what do I mean by same period is that you can see both are reflecting from April to October like that, April to October like that. Okay. So they are not, they are within the same time frame. They are not taken from different time frame. So anyway, stock A is actually AMD, and stock A actually went down after that particular candle. So this dotted vertical line is where I cut off, okay, where I cut off. So this is the candle where I cut off. So stock A is actually AMD, which kind of went down, and it went down about 28% up till yesterday, okay, it went down about 28%. And stock B is Astera Lab. So now, who have heard of Astera Lab before? Those in my course not counted, those in my community not counted. AMD, everybody know. Who heard of Astera Lab before? Most likely, most of you haven't, okay? And you can see Astera Lab actually went up 132% within the same time frame. Actually, within the same time frame. So both Astera Lab and AMD are somewhat related to the AI industry, okay? And you can see one totally outperform the other by like over 160%. So if you have long position in Astera Lab, of course you are bound to profit tremendously. But if you are in AMD, then you are bound to lose money. And this is one very good example to sort of show you that doesn't mean if you are bullish in AI, right, you just go and buy the most popular stock, be it Nvidia or be it Microsoft or Google or in this case AMD also. Okay, so sometimes there are actually a lot of hidden gems out there that you have to look at. But more importantly, right, we actually traded Astera Lab. You can see here AM. So these are all screenshots from my community. Okay, somebody got $1,900 profit, somebody got 40% profit. I personally got 17K on SA Lab option expiring January. When I exited, it was about 19K in total profit from this trade alone. So we actually took this trade. And the reason why we took this trade instead of AMD is mainly through fundamental. In fact, we spotted Astera Lab through fundamental analysis. It has nothing to do with technical. In fact, this whole trade setup, this whole trade structure, technical analysis was not involved at all. In fact, all the funny MACD RSI is just there to mislead you. And if you are within the community, I'm sure most of you have gotten a very big profit also. But anyway, the summary of the institutional framework, we are using long-short beta hedging strategy. Stocks are chosen through microeconomic and fundamental analysis. And market is actually horrendous at pricing things correctly, okay? So for those who believe in efficient market theory, I would say that is wrong because market is really, really terrible at pricing things correctly or efficiently. So with good fundamental analysis process, right, cheap gens are actually quite easy to find. And in fact, that's how we always find a lot of good stuff. In fact, when we found Palantir back in 2023, Palantir was only at $6. And in fact, we have been trading Palantir from $6 all the way until what, $70 now already. And when we found Palantir, everybody was bearish. Nobody was bullish on Palantir. Technical analysis is for timing only. So focus on mid-cap stock where the opportunity for growth is the highest. So this is something that a lot of retail traders do not know also. Most retail traders focus on the big names because the big names are familiar. They will never go bankrupt, but the never go bankrupt don't really often come into play. A lot of mid-cap stock are also very good and reliable in terms of their business wise, but the growth is a lot higher. Managing the portfolio as a whole is more important than individual trades. So you cannot be too overly focused on one individual trade, but you have to look at your entire portfolio as a team, as a soccer team. So from a psychological perspective, no shortcut mindset. Please don't go around asking what to trade give trade signal all this stuff, that is not going to make you a successful trader. There must be uncompromising commitment, okay? If you truly want to become a successful trader, you have to go all in. It's not something that you do because you're free or your butt itchy, hand itchy, want to press button a bit. If you are doing that, right, I suggest you download some online gambling app. Maybe you gamble $1, $2 can like urge can sort of like scratch that itch lah, okay, but trading is not for that purpose. So if you are here to copy trade, ask for trade signal, then trading is not for you. Nobody make consistent money from copy trading now. Okay, that's one thing for sure. So now, let's go on to the next topic, 2024 performance. Hopefully, I've covered sufficiently enough on how institutional trader trade. Obviously, I cannot go through the entire process because it's gonna take like one whole year. I can't condense that much information into a 2-hour webinar, but hopefully, I did sort of open up your horizon, open up a few doors, let you know certain words, certain terms, like things like beta neutrality, long short portfolio, where it gives you the curiosity to go and at least look it up on the internet. But to be honest, you probably can't find much information on the internet regarding all this strategy also. But at least it opened up the door for you. Okay, so now 2024 performance. This is, of course, Nimbus Capital. If you are in my Patreon group, you'll probably walk with us through this entire journey from day one, 0% ROI, all the way until 85% ROI. Okay, it was a gradual process. For those who are new to our community, what you see here is the end result, okay, not the journey. But I do want to highlight a few things here. Firstly, you can see the winning rate is 55.32%, so it is not like super duper high. We are not looking at what 70% winning rate, 80% winning rate. Those are very stupid, okay. Those are super duper stupid. In fact, in the institutional trading world, the winning rate is somewhere around 55 to 60. Nobody get higher than 60 or 70 like that. Maybe 60 still can, but beyond 60, right, is considered fake already, okay? Because there's no strategy is that accurate. And there is a very good reason why our winning rate is always around 50. It's always near 50. And that is because we are using long short strategy. Every long has a short partner. One of them is going to die, one of them is going to lose. So most of the time, your win-loss will always gravitate towards 50. And that's why all hedge fund win-loss rate will always be around that number. And next one is the median trading duration and average trade duration. This is how long we hold a trade. So you can see the average trade duration is about 40 days. The median trade duration is about 31 days. So we don't really hold that long, but it does cover a significant period. Okay, you must have sufficient holding power to hold through this time frame. Okay. So total profit for the year 467,000, total loss 297,000, which give us a net profit of 170,000. These are in USD. And average winning per trade about 6,000, average losing trade is about 4,700. Is this annual ROI for ROI? That's the annual ROI. So we begin the year with 200K. We ended the year with 370. So the net is 170,000. So 170,000 over 200,000 is about 85%. So 2024 ROI. Okay, so now a little bit more specific data. You can see here, we have 134 trades, 100 okay, there is a very small portion of Singapore stocks, and majority of them are US okay, but we did enter some Singapore trade there. I think 2 of them, if I'm not wrong, 2 or 3, I forgot already, but there are some Singapore trade okay. So overall, we have 83 bullish trade and 54 bearish trade. So obviously, we have more bullish trade okay. 2024 was actually a bullish year, so we are a bit more bullish bias, but you can see that we still have significant bearish trade. We still maintain that beta neutrality. We don't like, oh my God, everything bullish, so whole portfolio bullish. No, we don't do that. And trade by duration, you can see majority of the trades are in 30 to 60 days. And there are about 30 trades close within 10 days, enter ready, zao, and there are about 33 trades that close within 10 to 30 days and 31 trades that we held more than 60 days. But you can see here that a majority of the trade falls between 1 month to 2 months. Okay, we rarely hold trades more than 2 months. Majority of them falls between that. And you can also see that the highest winning rate come from trades that are within 30 to 60 days. And those that are close less than 10 days, right, there are a lot more losses because sometimes hand itchy take speculative trade then end up in a loss. So we immediately exit. Sometimes enter ready, next day drop 10%, we zao ready. Okay. So this probably is those kind of trade. So you can see Singapore trade, there's a winner. So we never lose, we have not lost on Singapore trade. 100% winning rate on Singapore trade, but you can see majority is US okay. So of course, bullish trade mostly win. Bearish trade about equal, but the winning trade on bearish is still more than the losing one. So even though we are in a bull market for 2024, we still make more money on the bearish trade than we lose on them. Okay, so it is still a very good result. And we did not take any agnostic trade. So I don't really want to go through what agnostic trades are. It's a bit complicated at this point in time. So overall theme for 2024, S&P 500 plus 25%, NASDAQ 100 plus 28%. So if your portfolio performance is lower than 25%, you might as well be buying S&P 500 okay? So most AI stock rallied, contrary to popular belief, AI is not a bubble and the rally is actually backed by material earning growth okay? There are actually physical money that is being made from all this AI development. So every time when I hear this AI is a bubble, right? More often than not, it is a narrative spoken by charlatans who are plainly looking at Nvidia and then thinking Nvidia too high already, should drop already, and then every time they short, right, they gonna burn. Okay, too many people already, too many people trying to short Nvidia. I don't know why. So anyway, there's a jumbo rate cut. There was a jumbo rate cut in September 2024. The 10-year US Treasury rose from 3.8 to 4.5, which is very funny and contradictory because we had rate cut in 2024, but the 10-year yield actually went up. But of course, there is an explanation to this. The federal fund rate is at 4.33%, and the yield curve actually steepened around September to October 2024. So these are all the major stuff that happened. So now I want to go through the yield curve a bit. So you can see here, currently the yield curve, this green color right now is actually steepening. 1 year ago, it was like inverted, okay? So if you look at the past 5 month yield curve, right, you can sort of like see the process. So it start to steepen somewhere around T equal 4, T equal 3 like that, which is around October, September, okay? And of course, the first jumbo cut happened in September. So that is where you see the steepening happening. I will answer your question during the Q&A, okay? So why don't you hold on to your question and during the Q&A, I'll answer them because in fact, to be honest, I'm a little bit behind on time already. And I don't really want to like go beyond like 11:15, 11:30 like that. So now, taking a look at overall sector for 2024, SMH performed the best. SMH is, of course, your semicon sector. Surprisingly, Jet performed the second best. Jet is airline sector, your United Airline, American Airline, and it was surprising that Jet performed better than the overall broad market, which is SPY at fourth place, okay? And KIE performed the third best. KIE is the insurance sector, which was quite surprising for me also. Like, why on earth the insurance stocks are going up so high? And we have SPY on the fourth place, which is the broad market. And then we have the IGV. IGV is your internet, okay, internet software. Of course, IGV and SMH are tied to the AI sector, so it's not a mystery that they are performing very well. But Jets and KIE kind of caught me by surprise. And when I created this graph, I actually went to take a look at United Airlines chart, and oh my god, it's like I was totally not aware of it. I don't know how it slipped through my screening lah. And on those that perform the worst, TAN is your solar sector, PBW is your clean water sector. These two are the worst. So obviously clean energy sector are not doing very, very well. And in fact, I have warned this before because after Biden administration, when Trump's take over, right? Trump is not really a clean energy person. He's like drill baby drill, more oil and gas kind of person, okay? And MOO is agriculture not doing that great, okay? So this is no surprise if you have put your money on AI, you are bound to outperform the market. Okay, so stop going around and saying AI is a bubble. It is not, and please stop shorting Nvidia. It may drop, but it's not gonna crash, and it's not worth the risk. So now let's go through our best trade for 2024. We have Victoria's Secret, long position, held for 36 days, a total profit of 26,600. Astera Lab, which I shared earlier, 19,000. And Alpha Metallurgical Resources, the only short position on the best trade list, 18,000, held for 261 days. So this is an outlier. Okay, this one I hold for like 8 months like that. Newmont Mining Gold held for 50 days, 17,000. SATS. So this is the only Singapore stock on the list, and it is probably the only Singapore stock that was traded in 2024, $15,000. Zim Shipping, $14,700, held for 89 days. So I will go through the logic behind some of them, but I will not go through all because we don't really have the time. But also no point to go through all. Okay, some don't really have a lot of logic. So Victoria's Secret. So Victoria's Secret was entered as a pair trade with Abercrombie and Fitch short. So we have a long short pair. Victoria's Secret was a long. Abercrombie and Fitch was a short. So I am not really betting on one particular company, but rather the entire sector itself. Though, so the thought process was that I want to bet on the apparel retail sector. In fact, I was bullish on apparel retail, but I wasn't really that confident how the apparel sector is going to be. So I pair it up with a short. So in case I was wrong and the apparel sector crashed, at least I have the short that can still make me money. So the idea was to long a undervalued apparel stock, which is Victoria's Secret, and to short a overvalued apparel stock, which is Abercrombie and Fitch. And if you are free, I suggest you go and look at Abercrombie and Fitch chart. It is crazy, it rallied like crazy. So due to this pair trade, whichever way the market goes, right, we are going to keep the winner and cut the loser. In this case, we keep the winner, which is Victoria's Secret. So you can see the two vertical line, which marks the entry date and the exit date. And the green color is the amount that the stock went up. So it actually went up 48%. That's not a small amount. S&P went up 25% in one entire year. Victoria's Secret went up 48% within like 30 days like that. So I am still holding on to Abercrombie and Fitch short, but I'm not going to lose more than like $4,000-5,000 on it, okay? But the profit on Victoria's Secret was $26,000. So next one, Astera Lab. This is betting on AI company with with potential for high growth. High data transfer is actually the current bottleneck in AI. So any company that is manufacturing high data transfer solution stand to benefit greatly, which is what Astera Lab is doing. So this is actually a laggard sub-sector in the AI industry. All the GPU fly ready. So now the next one that is going to fly is all the data transfer solution stocks. Okay. So not only that, if you look at the Astera Lab revenue, right, it is growing at an astronomical pace. You can see the highlighted red color box growing at 59%, 148%, 269%, 600%. The sales is increasing like crazy. So this is actually a no-brainer pick. And when I first found Astera Lab, the stock was like dirt cheap. So it is like a very simple choice in order to pick this stock. So you can see the price that we enter was 26 August at $40. It is like right at the bottom. We basically bottom pick this stock. And you can see that we didn't really exit at the high. In fact, the stock went up a lot higher after our exit date. But you have to understand that at the point that we exit, right, the stock already fly 57%. And it flew 57% within like 50 days like that, less than 2 months. So at that point in time, right, it was already a winner. It was already the biggest winner. And we don't want that profit to evaporate should it come down. So we actually exited because we thought that was the high. But in fact, it actually went up a lot higher. And the great news is that even though we only catch a portion of the rally, right, it was big enough to give us a $19,000 profit. So this is to show a few things. You don't need to exit at the top in order to have great returns, but you need the stock to move sufficiently. In this case, the stock actually moved 57% within a very short period. Um, can you ask the question in Q&A section? Thank you. I want to quickly go through very fast. I'll get back to you, okay? So the next one, Alpha Metallurgical Resources, AMR. This is the only short position on the list that is considered a huge win. So they mine met coal, sorry, Minja, typo error. They mine met coal that is used to manufacture steel. So there is an overall decline in construction volume in 2024 due to high interest rate, and it has actually resulted in lower demand for steel. Okay, so steel is mainly used in construction sector and electronic vehicle sector. So both construction and EV sector were declining for majority of 2024. So I thought with the sector declining, the demand for steel will probably go down. And at the point that I spotted this stock, the revenue growth has been contracting for quite some time already. They are not making as much money, but the company also stopped giving out dividend, and they also stopped the share buyback. So which is like somewhat a clue that maybe they are not doing well, probably because there's not much demand for steel. And when I want to trade this, the stock was actually at all-time high. So it is once again a no-brainer. Like this company, the demand for their product is dropping, their sales is dropping, they stop giving dividend, they stop buying back shares. Some of the stock at all-time high, don't know for what. So it's a very I would say easy, obvious overvalue short target. So the short was entered at 12 March. It was exited at 5th August. So it was held for very long, 5 months. And overall, the drop was 31%. So once again, you can see that after I exit, it actually dropped a lot more. I could have earned a lot more, but once again, right, you don't need to short the high, exit at the bottom, or you don't need to buy at the bottom, exit at the high. As long as you catch a portion of the trend, right, it is good enough. So next one, SATS. Okay, SATS, very simple. It has a strong correlation with Singapore Airlines, stock market movement and earning. So usually when Singapore Airlines earns money, SATS also earn money, okay? They tend to have very strong correlation. SIA, right, already hit the pre-COVID high. So SIA already rally until the pre-COVID high, okay, but SET is actually still at the rock bottom. So it is a very obvious laggard. And on 29th of May 25, on 29th of May 2024, SETS actually announced that their profit increased 10 times. And not only that, right, they are also resuming the dividend payout. So with that, right, it could be a good catalyst for the buyers to come back into SET again. So we actually enter SETs one day after the announcement, which was on the 30th May. And after that, we just hold on to the stock, okay? And we exited at 11 September 24, which was about 4 months of holding. And the stock actually went up 37.39%. So you can see here, right? Most of the trades that we have, the stock moved like 40%, 50%, 60%, 30%. We are not scalping for miserable 3-4%, those kind. We want big movement. But for sets here, right, it is also a very good example of catalyst. For a stock to move, right, a catalyst must be present. In this case, the catalyst is the resumption of dividend. Zim shipping. Zim is a very straightforward trade. So it is a play on Red Sea conflict. Okay, so in the earlier part of 2024, there was the whole conflict during the Red Sea there, the Suez Canal got blocked off, and then all the ship have to take a longer route, and then all the shipping costs increase, oil price increase. So obviously, Zim Shipping, being a shipping company, benefited from it. So we entered at 15 February, exited at 15 May, about 3 months of holding, the stock went up about 58%. So once again, this is not the high. The highest was don't know how high already, okay? But it is still a significant 58% movement. So now the worst trade for 2024, these are the losing one, the big losing one, but you can see even the big losing one, right? It is not as much as how much we win. So the idea is always to limit your loss, cut your loser, let the winner run. So we have Super Microcomputer Inc. held for 21 days, lost 15,000. Aspen lost 9,700 and Intel lost about 8,900. So Super Microcomputer Inc. SMCI, this is the worst because a lot of rules were broken. Firstly, it declined 60% from March to August. So thought it was a very cheap stock to pick up since it's already declined 60%. But as you know, in the market, cheap can go cheaper, okay? But the thing here is that I didn't really do a lot of proper analysis. I just thought, okay, I mean, this is AI related, so the overall sector bullish. And then I actually played a cash secure put option. So cash secure put option actually have potential unlimited losses. And just a few weeks after I entered this, right, there was a short report by Hindenburg that came out, and then it caused it to crash by 20% within a day. So the Hindenburg report stated that SMCI is actually fabricating a lot of their revenue. There's a lot of like unethical, some fraud going on within the company, and you can see how much the stock actually continued to decline. So because I was caught off guard by this short report, right? I lost quite a bit and just nice that the kind of structure that I chose to enter has potential for unlimited loss. So in fact, majority of my trade, I don't lose more than 10K, but this one was wrong place, wrong time, and I lost 15K. The other one was Aspen, loss-making company that is seemingly improving at a rapid pace. They manufacture thermal and insulation solution for electronic vehicles. So I got a little overconfident on this trade because of the fundamental, and I actually risk more than usual on the trade. Okay, usually I risk about 5,000, but this trade I go and risk like twice the amount, like 9,000 like that. Then the company actually announced new stock placement, which heavily diluted the current stock. So that lead to a huge decline in stock price. So this doesn't really change the fundamental, but it is due to the stock dilution. So sometimes certain things can just unexpectedly happen. Okay. You can do all your analysis correctly, but when this kind of news come out, there's nothing much you can do. So I took the loss and the stock went down about 45%. Lastly, Intel. So Intel is a speculative play on potential takeover by Qualcomm. There was a news that came out, but it didn't happen. So it was a pure speculative play with no homework done. And I even convinced myself that, okay, worst case, Intel should still go up because it is actually value based on the price alone, because this stock has fallen 68% from the high and it's actually at 2016 low. 2016 is like, don't know, like 8 years ago. It's like, how can a AI related, chip related stock fall until so low? So I thought, okay, cannot go lower already. So I went into it and not surprisingly end up in a loss. Okay. So the lesson here is that Intel is a shit company. So like I don't know what Intel is doing. The entire chip sector, foundry sector rally like crazy on crypto, and then they have a second chance with AI rally again, but no idea what Intel is doing. So a summary for 2024, moderately bullish year led by semicon and AI sector. Very straightforward theme, no trickiness involved. Sometimes you don't need to like be a smart aleck. Okay, sometimes just follow the AI herd. You are bound to outperform the market. It is those that try to be smart aleck when like say AI bubble this and that, go and short here, short there, and then gonna burn. uh Airline sector have rallied aggressively. So now I would say airline sector caught me by surprise. But then again, right, we benefited from the airline sector through SATS. So even though SATS is a Singapore stock, it is still within the airline sector. So I will give myself the half a point. Okay. The insurance sector outperforming broad market was a surprise. So from my own self-reflection, big losses in 2024 were incurred due to incompetency and deviation from my workflow process. So mainly SMCI was all the bad things happening at the same time. I did not use a proper structure. I went for a structure that have potential unlimited loss. And then at the same time, we have bad luck from Hindenburg. And then I didn't really do the workflow process properly also. But nonetheless, right, 85% ROI for the year is a phenomenal return. And in fact, it is one of the biggest return that I've gotten for my trading career. And this is despite a lot of a mistake that is being made, which I believe without no mistake, it could have been better. At some point, I was about 101% ROI, but towards the end of the year, I took my losses and it dropped all the way back down to 85 lah. So my goal is to just maintain my performance and be a little bit more disciplined in 2025. So sorry, 11 ready, but let's go through the last portion now. Okay, I believe this is the one that everybody is waiting for. So now, what to expect for 2025? So now, Trump is a big factor. Trump administration will be a huge impact on what kind of sector and company you should be focusing on. So as I go through all this point, right, I want you guys to make a mental note of what kind of things that you want to trade. Okay, what kind of stock that you should look for. So firstly, infrastructure and industrial. Trump is very big on huge industrial infrastructure projects. Okay, he tend to streamline all this project and get them executed. Oil and gas, so this one not a big surprise. And gold to decline as Trump policy tend to strengthen USD. And Trump expansionary policy usually lead to reinflation, where inflation start to go back up because everything is growing, and all this growth can lead to inflation now. So long anti-inflation sector or short sector that may be affected by the inflation. So these are something that we can look at. And of course, a tariff, probably a lot of tariff. And from what I read, Trump is now focusing on imposing European tariff rather than Chinese. So a little bit weird, but we shall see lah. Okay. And AI policy. So Trump is a lot more relaxed in terms of regulation compared to Biden now. Okay, so I would say that a lot of AI stocks still have room to run, but be picky in what you choose lah. Okay, don't everything Nvidia or AMD. There's a lot more out there. So I want to reshare this slide again because currently right now the yield curve has steepened already. It is no longer inverted, and this actually have a few implications also. So now looking at the manufacturing PMI, which is now standing at 49.3%, and you can see it kind of like spike up quite a bit during the last few months. Same thing for the service PMI, currently standing at 54.1%. So it does seem that from the business side, both service and manufacturing are doing quite all right. They are not like contract. Okay, manufacturing, technically speaking, is still contracting, but I think they will soon be back to growth lah. Okay, but service PMI is still improving by quite a bit. Of course, I mean, I don't expect you to know how to read all this data unless you come for my course, but I'm just sharing the information with you right now, the kind of information that we actually look at if we want to determine if we are bullish or bearish in the long term. So, and also based on Federal Reserve economic projection, if we look at 2025 GDP projection is 2.1%, which is a little bit pathetic. 2024 was 2.5, but the GDP for 2025 is 2.1. So it is still growing, okay? It is still growing, but it is growing at a slower pace lah. And the federal fund rate projection is at 3.9%. Meaning to say there will only be 0.5% cut or 50 basis point cut, because currently the federal fund rate is sitting at 4.4%, and their target for 2025 is 3.9%. So that's about 0.5% cut. Okay. So initially it was a 100 basis point cut, but during December they raised the federal fund rate target. So now with all those information, right, we can conclude a few things. The steepening yield curve typically indicate accelerating expansion in the economic activity. So the manufacturing and service ISM also support this future expansion in economy, which is most likely due to Trump administration. Okay. So even though Trump haven't do anything yet, right? The market is always forward looking. The bond market, especially the yield curve, is very forward looking, so it is pricing in a lot of like future events already lah. So is the manufacturing and service ISM also. They are pricing in a lot of what they feel the future will be. So with all this expansionary effect coming in, right, it could also mean that there can be a increase in inflation, and Federal Reserve reduce their rate cut expectation for 2025 from 100 basis point to 50 basis points. So their federal fund rate target is 3.9%, up from 3.5%. So if inflation if inflation start to increase, right, due to all the expansionary policy, we might have no rate cut for 2025. So that is actually a possibility lah, okay, where no rate cut actually occurs because suddenly inflation is going back up due to Trump doing all sorts of funny thing lah, okay. And also be reminded that the GDP forecast is 2.1% compared to 2024 2.5%. So now we have covered so much of what we are expecting for 2025. So with all this information, right, usually a retail trader will think, oh yeah, you talk so much, so bull or bear, long or short, like what, long S&P short S&P So a retail trader will always have this binary mindset, whether something is up or down, long or short, recession or no recession. And this is something that as a institutional trader, you need to get yourself away from. So what will institutional trader think? After all that I share, right, a hedge fund trader will be thinking a lot of things really. So these are the stuff that you will be thinking. I need one long position for infrastructure industrial stock. I need one long position for oil and gas, which just nice, oil and gas is naturally anti-inflation also. So if inflation goes up, then a lot of oil and gas stock will goes up also. They probably need one short position for any stock that could be affected by European tariff. For example, any wine importer, any US company that import wines, or maybe chocolate. So this could be, all these can get hit by tariff if tariff could happen. I could still have at least one long position on AI related stock. It's good to still have some position on some exposure to the AI sector. And if inflation increase and there's no rate cut for 2025, I should short one or two stocks that may be negatively impacted by higher inflation or higher rates. It could be home builders, or it could be travel vacation stock. When inflation increase, air tickets start to increase, your hotel stock start to your hotel prices start to increase. So maybe all the travel vacation stock may start to have price war, or some stuff going on there, okay? Or maybe restaurant, due to food inflation, maybe you can short some restaurant sector. So these are the stuff that will go through a institutional trader mind. They will not sit there thinking, "Aya, you say so much, bull or bear," like that kind of mindset, okay? So now, considering that the GDP growth for 2025 is quite mild, I should actually maintain a neutral portfolio. I should not be overly bullish. So maybe I will maintain a 4 long, 4 short portfolio that is a neutral portfolio. So with all that said, let's go through the potential trade for 2025. So now, first trade, Argon, AGX. This is the industrial and infrastructure long. Firstly, it stands to benefit from Trump policy. They build energy facility and sell industrial construction services. There was a massive sales and earning growth in the past 3 quarters. You can see the sales went up 52%, 60%, 56%, and earnings went up like 400% in the latest earnings now, okay? So company currently at 2.38 billion market cap, but they actually have a backlog of 1 billion. So they have a backlog that is 50% of their market cap, which means to say there's a good chance that their market cap can actually go up to like 4 billion like that, which means to say the stock price could effectively double, okay? I mean, just saying. So Trump also stated that he aimed to charter 10 new cities on underdeveloped federal land and streamline the approval infrastructure project, which means that AGX could be, Argon could be a beneficiary of all this policy going online. And unfortunately, Argon was the very first trade that we shared within our inner circle. It was on 6th of January. And since then, right, Argon actually went up a lot already. It actually went up quite significantly already. But I think it has the room to go up a lot higher. So if you look at the chart, it just broke through the resistance. You can see the momentum indicator, the MACD crossover, the signal line, the RSI going up, whatever TA you want to use, okay? And my price target is about $240. Of course, the holding time frame maybe until the next upcoming earning, okay? So if you decide to go into this trade, make sure you have your own money management, risk management, okay? Don't YOLO, don't go and close eye, copy trade, enter because Zor says so. This kind of attitude won't work if you want to be successful trader, okay? So make sure you have holding power. Make sure you have holding power. So that's what I want to emphasize. Next one, Transocean or rig. This is oil and gas long. So it's a very simple oil and gas stock. The company just landed 111 million deep water exploration contract, and their entire fleet is fully contracted for the next 2 years, meaning to say they are working at a 100% efficiency, okay? And their operating margin has also expanded substantially. So this is nothing complicated. Of course, the backend work is a lot more complicated, but this is the summary, okay? I don't want to bore you with like 10 page of trade reports. So rate currently he has declined quite a bit. So now if you want to strictly look at the technical, I would say that maybe you may want to wait for it to go up a little bit higher for it to like break out of this downtrend before you enter. So I put my entry price around 4.5, but I mean, to be honest, I personally have entered this trade already, but it's an option position, okay? So usually option position, I don't really care so much about technical. I just enter before the expiration, it goes to my price target, I'm happy already. I don't care what really happened in between. Okay. But if you are a stock trader, maybe you may want to wait for the momentum to go up a bit more. Lah. So potential target around 6.3 or 7.3. Next, Toll Brother is a home builder, so this is a short position. So this is in those situations where inflation increase and the yield go up, then maybe no rate cut for 2025. The sector that will be affected the most are home builders lah, because home builders are affected most by high mortgage rates. Toll Brother built luxury home, which are actually the hardest to sell in the home builder space compared to your average Joe houses lah. Okay. And Toll Brother also have increasing inventories, which is the sign that they have trouble selling their newly built homes. And also, based on data, a lot of the resale home are entering the market, which may increase the overall housing supply. There could be more competition for the new houses. So Toll Brother currently it has declined quite a bit already, but now it's recovering. So this is not like Monday go and enter kind of trade. Maybe it will go up higher, but what I'm looking for is I will let it rebound. Maybe it can rebound as high as this one. But the moment the momentum turn down, the moment I see price action a bit going down, right, then I will short. Okay, but for now you can monitor it, wait for it to go up, just let it be whatever. Okay. Price target is somewhere around 95. Next, Barrick Gold, gold mining. This is short. So this is very simple. Trump administration tend to lead to stronger USD. And Trump also advocate peace talk to improve business relationship, especially in the Middle East area. So both of above mentioned factor, right, tend to create weakness in gold, mainly because a lot of people buy gold as a safe haven when everybody is at war. But Trump is a little bit more peace loving, okay. So I mean you can't deny that. And Trump is also very pro crypto. So this tend to lead to like those funds that are seeking safe haven, right? They may flow into crypto instead of gold as a safe haven or as an anti-inflationary asset. Okay. So overall, usually when Trump enters the office, based on the past experience back in 2016, gold tend not to do well. So this is Barrick Gold. I don't short the actual gold, but I will short gold miners for one very good reason is that you can play options now, okay? And stock move a lot more compared to actual gold. There's more volatility here to play with. So now Barrick Gold is similar to Toll Brothers where it has dropped quite a bit already. I think it can drop lower to 13.5, but what you want is you want it to recover a bit, okay, so that you can get a better price. Or if not, you wait for this consolidation to get broken down, then you enter. At this current stage, it is still like sideways. So if it break out, then you let it break out, you wait for it to go higher, and then you short when the momentum start to turn. Okay, lastly, Credo Tech. This is AI long. Credo is actually quite similar to Astera Lab. They manufacture high volume data transfer solution for data infrastructure market. So in fact, Credo is a leader in this market. So as I mentioned, right, the data infrastructure is actually the last bottleneck of AI because you have all these GPU ready that is able to calculate a lot of data at one go, but you calculate all these data already, you need some way to transfer. You need a way to transfer high amount of data at a very a fast pace, and that is the current bottleneck. And Credo seems to be the leader in this market, and their revenue growth is insane for the past 3 quarters, and the guidance for the next quarter earning, right, is actually 300% higher than the previous year. And this is very, very similar to NVIDIA before the huge AI rally. Remember when NVIDIA break above the all-time high, and then after that it just went berserk all the way until like 1000+%, right? So Credo seems like the beginning of what NVIDIA used to be. So currently Credo already rallied 50% on earning. But the overall future guidance suggests that there's more upside. So here, Credo actually rallied 50% here, but it's consolidating a bit. But I do think that there's a chance that there's sufficient backing in terms of earnings that they are generating, the sales that they are generating, and future growth for this stock to actually go up a lot higher. Okay. So it's something that you can slowly enter, slowly enter, and then see how much you can get from it. Okay, so now that's all I have. So before I go on to the Q&A session, right, just want to share with you a few ways that you can engage with us. So I will send you this link. Wait, give me a moment. I will send you this link before I explain a bit. Sorry, I'm gonna stop my screen share for a while, okay? Okay, guys, I actually dropped something in the chat. It's called Contact. You can go and download the BT PDF. So the PDF is this link, this page, lah, okay? So you have access to all the link if you want to join our community. So that, I mean, if I mean, I don't expect you to go and copy down all this link, lah, okay? So the main way to be involved in our community is the Discord channel. You can click the Discord link and then you need a Discord account. Okay, so it's free of charge. You have access to the public channel. You can engage with the team. You get occasional free analysis. And sometimes we will hold public event which you can join also. Okay, sometimes we will meet up face to face. So just to show you an example, this is how our Discord will look like. So you can see if you are a free user, you have access to the public area. You have access to this public area. Of course, if you are a subscriber to our Patreon, you have access to the private channels, okay, where we will share trade setup. So you can see Argon setup that went up, all this kind of stuff, okay. So that's the Discord channel. Nimbus Capital Patreon. So this is our paid monthly service. So it costs $30 per month. And for $30 per month, you have access to our weekly webinar, trade report. You have access to our portfolio, which I will share so that you know what I'm trading, how much I'm trading, all the positions that I'm holding, the trade ideas, the trade setup, and of course the private Discord channel, which is what I shared just now. And sometimes we'll have yearly meetup with the subscribers. So I try my best to have a yearly meetup, but sometimes you all don't want to meet lah, okay? You all don't want to meet, then I don't spend money lah. So I mean, of course, I will need minimum number of people that want to come lah. If not much people, then of course I don't hold lah. Okay, next is our Nimbus Capital website. So nothing much on the website, but if you are looking to attend our course, right, you can take a look at the website. And this is something that I quickly want to shamelessly share also. Our 3-month course, our 3-month training course will be open on March 2025 tentatively. So if you want to join this course, do come to our website, nimbuscapital.info. Go and take a look at the information here on what you will be learning, and mainly you'll be learning what I have shared in this presentation, okay? But of course, in more detail, how to do proper macroeconomic analysis, proper fundamental analysis, how to construct a long short portfolio, how to manage a long short portfolio, proper money management, blah blah blah, all this lah. Okay, so go and take a look. Currently the registration not open yet. But when it open, I will definitely announce on Facebook or Discord or wherever lah. Okay, so do go and take a look if you're interested. And sorry, and of course, trading course, I take in a very limited seat because once again, right, I don't take like 50, 60 people. Usually I only take like 20 people. sometimes the older batch will come in to sit for revision, but I don't really take more than 20 people because I don't like big groups, and I also don't suka take people. Also, sometimes there are people who just want to come in for free trade signal, all those which I don't really like also okay. If you have the money to burn, you can come for one-to-one mentorship also, where I will mentor you one-to-one, more attention okay. I will look through your actual portfolio personally. I will guide you through how to manage on a live market. So if you are interested in that, you can drop me an email. Facebook group. This is our Facebook group okay. The Stock Master group. This one which I believe you all should be aware. YouTube, we have a YouTube, but I don't post that often. Once in a while, there will be an occasional video, but not always okay. But you can go and take a look. And email nimbuscapital.info. This is my email. If you have any things that you want to ask me personally, you can ask me there okay. But I would say that if you want to reach out to me for the fastest response, right, it's actually Discord, because I have 24/7 access to Discord. So if you need to ask me anything, you can just ask me here, public area, message to Nimbus Capital, just type whatever you want, whatever question you have. I tend to respond quite fast okay. So next, I am a what will you call ambassador of City Index, or spokesperson of City Index. So they currently have this promo where if you sign up account with them and you deposit $2,000 and you make at least one trade, you have $50 cash bonus. So you can basically enter one position in out, like just scout, you get $50 like that already, and it's cash, so you can withdraw it. But of course, if you are a little bit more ambitious, you can get the tier 2 $200 cash bonus if you trade 1 million worth of product, mainly index. But 1 million sounds a lot, but it's actually very simple. For example, if you make one Dow Jones trade, if you trade one contract of Dow Jones, in and out is about $80,000 already, in and out okay. Entry and exit is about $80,000 already, because Dow Jones currently right now what, $40,000 I forgot already okay. But in 40,000, exit 40,000, just scalp that small amount is about $80,000, which means you in and out 12 times, right? You probably hit 1 million already. So maybe along the way you lose $10 here, $10 there, but I think overall you wouldn't lose a lot and you are getting cash bonus of $200 okay. But I think 5 million is a little bit too much but 1 million is easily attainable if you just in out Dow Jones like 8-9 times okay. But of course, I mean, like, I'm not forcing you okay. You want, you go and do. So personally, I use interactive broker. I use City Index, but not often. I do have a City Index account. In fact, my City Index have 100K inside, but I don't trade that often on City Index okay. But I just so happen to be their spokesperson. So if you are interested, you can use my link, go and sign up. Is in the same contact PDF that I sent. Just click it and then you can go and sign up okay. If you are looking for a trading platform. So as I mentioned again, right? I usually use option to trade. So City Index don't have option. Hence, I use interactive broker. But sometimes if I no option choice is available, I may use City Index to trade leverage stock position okay, guys. So we come to the end of the webinar. I'm so sorry to exceed by 30 minutes. We started slightly later also, but I always have the habit of like exceeding the time okay, because it's my passion, too many things to share okay. So anyway, Q&A 15 minutes. For those who have asked question earlier, you can please ask them again now. I may have missed it, or I don't know who asked what okay. I will try to answer. Oh my God, like one big list. Do you stack your winning trade? No, I don't really stack winning trades because I use options. So once I enter option, the risk reward ratio is set, the risk is set ready, everything is set. So I don't stack onto that lah. But what I will tend to do is I will always look back at trades that I have win before. I will see if the fundamentals are still intact, if the trend is still intact, and then I will enter new position after I have exited my old position. But this is mainly because I use options. If I am using stock position, and if based on my conviction, maybe I will slowly scale up, I will stack, I will shift stop loss, but it's a little bit more complicated, lah, okay? But since majority of the time I'm using options, right, I do not stack. What is your course of action when government take measure goes against your trade sanction, blah, blah, blah? Okay, I mean, if government do something, then bo pian lor, just cut lor. So I won't hold lah. So depending on what government do, like I have to handle it on case by case, okay? And if it does have material impact on the stock, then definitely have to I will exit lah. So sometimes conviction is you have to be a little bit wary about conviction also. So one example I can give is that at one point I was actually shopping the China market, and then suddenly China come out with some stimulus. Then I immediately cut my loss and I just move on already. So now I will also once again mention that since I use options, right? Options, for those who don't know, your risk is actually limited based on the structure you take. So most of the time, I will take structures that limit my risk. Meaning, no matter what happened, if like the entire world burned, the stock market crashed to zero, option, you will only lose the amount of money you pay for the option. Meaning to say, if I pay $3,000 on the option, I will lose $3,000 on the option. So in this kind of scenario, right? The worst I can lose is 3,000 example, then regardless conviction or not, maybe I just hold my position because I'm not going to lose more than 3,000 no matter how bad the policy is or whatever lah. So it is actually quite dependent on whether I'm playing a stock position or an option position. How do you know if a catalyst will be forthcoming? That is based on fundamental analysis. Most of the time, a catalyst is usually present in the earnings. You will know when the next earning is. So earnings date is 50% of the time our catalyst. So you have a catalyst with a known date lah. How do you scan and pick thousands of stocks? So we scan and pick stock based on fundamentals. So in fact, let me show you the actual scanner, and it is not some AI or the very fanciful. We use old school Excel sheet. But of course, since we are using old school Excel sheet, there is no button there that you can press and then the button will give you all the stock. No, we have to manually go through. We manually go through all this. We have to make use of the parameters. We own self set the parameters. So as you can see here, a lot of all the parameters are fundamental based lah. Okay, there's no technical based parameters here. Of course, how do you exactly use that? I mean, that one, you come for the cost, okay? What's your take on REITs 2025 without rate cut? So overall, I am bullish on REITs, but over the long terms of like 3-4 years, I'm personally slowly picking up any REITs that drop in price, but of course, not Tom, Dick, or Harry REITs, okay? I'm actually quite bullish on Singapore industrial sector. I have Maple Tree Industrial REITs. I'm also quite bullish on the retail space. Like for example, I have Fraser. I have Fraser, but basically all the big ones lah. So the key thing is not to go and one shot put all your funds into risk, but if you are looking to enter slowly scales in. For example, if I have a budget of $20,000, I'm not gonna enter $20,000 straight. I'm gonna enter maybe 3,000. If it drops some more 3,000, if it drops some more 3,000. But once I enter that $20,000 already, right? Of course, I'm not going to enter some more. I'll just leave it there. But if you have been buying REITs during the high and then you are holding at a loss and then you don't know want to dollar cost average or not, then that one different situation. Okay. When you are dollar cost averaging, make sure that you dollar cost average with a plan and you don't blindly dollar cost average and then blow up your entire risk. Like how do you set your budget for each trade? So every trade is set with a stop loss as a budget, meaning to say I have a fixed amount of risk that I can take for a trade. For example, with my current account size, I can take about sing $10,000. I can risk sing $10,000 per trade, and I will usually profit sing $25,000 per trade, somewhere about 1:2, 1:3 kind of risk reward ratio. So based on that risk, based on my entry price, based on my stop loss, based on the option price, of course, you have to do the maths and the calculation, but the budget is always set via the risk. What is your typical position size? So once again, my position size is based on my risk. So for now, my risk is about Singapore 7,000 to $10,000. It is usually around 2 to 3% of my total portfolio. For example, if my total portfolio is USD $300,000, and then you take a 3% of that, and then is what you will get lah. You mentioned you do not aim to catch high or the low so long the reason is return. How do you gauge a good exit? How do you determine your exit point? So the exit point is determined through volatility analysis. So recall that I mentioned I will hold a trade for about 2 to 3 months where the catalyst window is present. So once the catalyst window have passed, which is usually the earnings, I will gauge whether or not the stock respond to the catalyst. If the stock doesn't respond, then I'll just, okay, never mind, I'll just exit. Because once again, I'm entering option. My option usually have 3-month expiration. If the stock is not going to move, then my option is going to expire, so I'll simply just exit lah. So the exit point is based on volatility. So I will gauge within the 3 month how much my stock can move based on past movement. So for example, Tesla can move about 20% per month. So if my time frame for Tesla is 1 month, I'll probably set my price target for 20% gain. But let's say if I'm trading Apple, Apple probably move like 12% a month, which is not as much as Tesla. The volatility is a lot lower. So if I'm trying to trade Apple, then my profit target will probably be much lower than what I set for Tesla. So that is also goes the same for stop losses. Your stop losses have to be also based on the stock volatility itself, which is why in the presentation I mentioned one statement that say retail trader don't really understand volatility because they don't really understand how to calculate it, what is the mathematical procedure to calculate the volatility, because your stop loss and your profit target is pretty much dependent on the volatility of the stock. Last question, if you don't mind, can share your ROI in the last 3 years. So 2024, 85%, 2023, 80%. In fact, you can see the 2023 one on my YouTube is right there. I don't have the link lah, okay? Okay, wait, I do have the link. You also go and see lah, okay? It's a 2 hour long video. It's exactly like this video lah, okay? So it's 2 hour long. So yeah. And in 2022 wasn't a lot because 2022 market actually crashed. My ROI was about 65%, if I remember correctly. But 2022, we were heavily short. So for those who were with us in 2022, we were basically shorting the entire year lah. Yeah, you can come and see this video. Okay, this is for 2023. It's basically the same format that I did for this webinar. It's about 1 hour and 56 minutes. Okay, guys. So if for those who have any more questions, you may continue to ask. If not, you can leave or you can sit and wait for me to answer somebody else's question. So I will stay for another 11 minutes. I will leave at 11:50 lah. Okay. So if by then no more question, then I will also leave lah. So okay, if in the next 2 minutes I don't see any question, I will leave. Okay, so anyway, for those who are first timer here, first time coming to this webinar or first time listening to me present, right? I really it's my honor, to share all this information with you. And of course, I mean, I know I did share some course or Patreon or whatever lah. Okay, but don't feel obligated to go and pay or what. I mean, if you want, I mean, please do so, but this is not an advertisement for course or whatever lah, okay? I do believe I shared quite a lot of information that you probably won't find in even paid courses. It is really something that nobody out here will share lah. What is your take on China market? Okay, I am a very anti-China market. Not because I'm anti-China, but currently they are not doing very well lah. Okay, so for the entire of 2023 and 2024, right? The entire world is facing inflation problem. Even Japan, who have history of deflation, even Japan is facing inflation, but China on the other end, right, they are actually facing deflation, which is very bad. And not only that, right, the entire China economy, the entire China GDP is dependent on government policy, which is mainly concentrated in the real estate sector. And the real estate sector in China has actually collapsed really. I mean, this one you all know lah. Country Garden, Evergrande, all these company collapsed really, which at least sort of pull down overall China economy into a very, very bad state. Yes, they still have 5% GDP, but you have to understand that China at one point have 8%, 9% GDP, but now the growth has collapsed all the way down to 5%. And for the first time in history, they are facing population decline, which is like China population decline, like all the memes are like not working correctly, really. And at the same time, they are facing deflation. And right now, even though China government is announcing all sorts of stimulus here, stimulus there, the market is simply not responding. So I am anti-China because of all these factors, because I'm just trying to like stay away from it until things are a little bit more clearer, like where if China were to regrow again, right, then where is the growth coming from? Okay, so previously the growth is coming from all the low interest rate, all the what do you call that, the property, all this kind of stuff lah. But currently China is unable to ride the AI wave, which is a very, very bad thing. The entire all the company in China is being left out of the entire AI wave that US is riding, and China can't do anything about it. And the thing is that China is not equipped to monetize AI. They are not even equipped to properly develop AI. And I have shared this in my inner circle before. In order to develop AI, you need readily available source of data, a mass source of data for your AI to work on machine learning. And US have all these data available from Google, from Facebook, all these data sitting there to be utilized. But China, they don't have that source of data. What they have is propaganda. What they have is government curated data, which your AI cannot work on. It will just give you stupid result that nobody want to use. That's why you see all these funny jokes about China AI, where somebody write a sentence and then the China AI will give you like a literal picture or whatever the person wrote, and it's really bad. It's so bad that a lot of Chinese companies who are looking to further AI, they are actually coming out of China. They are setting shop somewhere else. Like for example, Lenovo is setting shop in Singapore. They want to distance themselves from China because that's the only way they can move forward in that AI department. So is very hard to tell where is the next growth factor in China will come from. And until that become clear, right, I will stay away for now. And the strategy that Chinese government is using, they are just 砸钱, stimulus this, stimulus that, which works in the past because the real estate sector is still intact. But now that the real estate sector is collapsed, right, all these stimulus is not doing anything, and it's not like paving way for the AI also. So something have to change. Either the regime change, or I don't know lah, something must change. And I feel sorry for those who are holding like Baidu, Alibaba, waiting for the recovery, and the recovery is not coming. I mean, if you have been with us, Members Capital, right? The last Hong Kong trade that we took was in 2021. That was the last Hong Kong trade that we took. After that, we just like, okay, let's stop. Let's stop. Let's not go into Hong Kong anymore. Welcome. Any SG stock pick? For trading, no. For trading, not really. But I am picking up certain REITs lah, okay, which I shared just now. So for example, Maple Tree Industrial. No, not really. I think the issue with Singapore is more of the lack of choices. I mean, Singapore economy is quite strong. Singapore economy is very strong. They are not we are not having structural issue like how China is facing. But the thing is that there's no good stock on Singapore market. Every good stock has been privatized already. The last trade I have on Singapore was Dynamac, and Dynamac was privatized as a very stupid cheap price of 60 cent or 60.5 cent. Every good stock is being privatized. There's nothing really. Yeah, I mean, if you want XG, if you want to trade banks, you just dollar cost average STI ETF lah. I mean, you don't really need to trade them. I mean, they are bound to go up. Might as well hold them long term. They give very nice dividend also. In fact, I do have a very large holding in STI ETF, which is mainly the three banks lah. But that is purely for dividend purpose lah, not for capital gain purpose. I mean, once in a while, I will find something like SETs that I shared, and yeah, I mean, it came in. I found it at the right time with the right catalyst. Of course, if the opportunity present, I will definitely take the trade. But most of the time, I don't focus. I don't focus on Singapore market lah. There's lack of volatility and lack of choices. Like if you are bullish on gold, what are the available choices on Singapore market? There's only one CNMC gold mine. Nothing else really. If you are bullish on oil and gas exploration, there's only like one Rex International, which is not even a very good company. No, I don't play crypto. But of course, I mean, as what I mentioned before, Trump is pro crypto. So I will lean on the bullish side, but I am strictly no crypto person, because I don't believe in the fundamental, the thesis behind crypto. To me, crypto is created as a vehicle to scam people lah. In fact, I love this video. I really, really love this video, which I shared to a lot of people to go and watch. Is one of the best analysis video ever. I'm not sure whether you all have heard of this guy before. Oops. Please go and watch this. Please go and watch this if you have the time. It's on crypto. Where is it? This one. Line goes up. For online content creators, the unavoidable problem with NFT line goes up. It's 2 hours and 80 minutes long, but I assure you it's worth the watch. I have watched this like 10 times. I just like listening to this guy talk. His command of English language is like wow. What are my thoughts on SG Semicon? Not really that bullish. In fact, I have Franken, and Franken Franken is like dying. So, if I'm looking to go into any semicon related stuff, nah, not SG. Franken's dying. AEM also dropped until don't know where. So, not that bullish. When it comes to AI or tech, right? SG is not the place, lah. SG is not the place. Any thought on Max 7? Okay, I don't trade big cap stock. I don't trade popular stocks such as the Max 7, so I can't answer that because there's I don't like any of them. For example, as I shared with you earlier, when I'm looking at AI stock that I want to long, if you look at my choices, there's no Max 7 stock there. In 2023, I long Astera Lab over things like AMD, over things like Microsoft, whatever. And in 2025, the AI stocks that I'm looking to long is Credo or AI Semicon, whatever. Okay, so if you like Max 7, just buy S&P 500 because all the Max 7 are in S&P 500 and it's a little bit more diversified. So for the institutional framework, right, we will tend to favor mid-cap stock. We don't really go for mega cap. So no Tesla, no Nvidia, no Microsoft, no Amazon. And the reason is very simple. If you look at Astera Lab, let me bring up the chart. It went up 130% within 3 months. No Max 7 stock can have that kind of performance. When Nvidia was before Nvidia went up during that big crazy rally, right? It was a mid cap stock. It wasn't a mega cap yet. But because of the rally, it became a mega cap stock. Okay, so if you look at Astera Lab here, right, this kind of performance, I mean, let's not talk about the 100%, 200%. Let's just talk about this 54%. No Max 7 stock can rally 54% within the same time frame as A Lab. So there's another AI stock that we entered, but we didn't really earn a lot. But I do have a few traders who held on to the trade, and that is Applovin. We entered Applovin around here, around $78. And it went up 416% within like from August to December, within like 4 months, went up 416%. There is no mega cap stock that can give this kind of performance. So that's the reason why we don't enter Max 7 or any mega cap stock. For example, Coca-Cola, McDonald's, all this we hardly enter because the return is not there. But for mid cap stock, they can fly one. That's why you can see for a lot of our big winning trade, right? They went up like 40%, 50% within a very short time frame. Another reason is also we are trying to get alpha return. The definition of alpha return is that you want something that is outside of the benchmark. You want something that can perform better than the benchmark. If you are playing Max 7, which is the benchmark, then you cannot perform better than the benchmark because you are playing the benchmark. The best you can do is the benchmark. Okay, last question before I end this session. One final question. Come. Anyone? Quantum stock. Oh, Credo went up 5.6%. Yeah, I think currently right now quantum stocks are a little bit on the high because I have not really seen any material returns yet in terms of profit or revenue growth lah. So not much substance there. To be honest, I have not really did my research on that sector yet. So I'm so sorry. I can't comment. I can't comment much on it. But perhaps there may be something there. I might take a look at it over the weekend. Okay, guys. I think that's all for this session. Thank you for the question. Thank you for those who stayed. So I will try to upload this video. And for those who are looking for the video recording, you can join Discord channel. You have access to the public area. And in the public area, right, there's this public video, lah, okay? There's this public videos and articles. So you scroll all the way down, you will see this. And then from here, right, I will upload the recording here, or you can go straight to our YouTube. I will upload it on YouTube also lah. It will be a public video. Okay, guys. Thank you so much for coming. Thank you so much for sharing. Have a great weekend. Sleep well, and we are going into the earnings season already. The bank's earnings are out next week. All the tech earnings will be coming out. I believe Netflix, Tesla, all these earnings will be coming out now. Okay, so maybe there's some volatility in the market that we can take advantage of. But hopefully, you can join our Discord server, even in the public channel also, we have some stuff once in a while. Okay. So thank you guys. All the best and have a good night.